Oh man, I think I stopped that accidentally. Anyway, so deducting taxes doesn't mean you get to write the whole thing off and not pay that much in taxes. If I have a $10,000 write-off, doesn't mean I don't have to pay $10,000 of my taxes. It means I don't have to pay whatever my effective interest rate is, or not interest, effective tax rate is on my marginal income. So after everything's all counted and said for your earnings before interest and taxes, you subtract your interest expense, then you have your earnings before taxes, and then you calculate your taxes based off your EBT, which is earnings before taxes. Now, and the interest is usually interest income, which is net, and there's unearned interest income and all sorts of stuff, because you can't count unearned interest income, which is actually a really hot topic right now. Nobody even knows what the heck they're talking about when they're talking about it, which is funny. I've had a lot of conversations where I just had to just let them talk and try to get out of there because they had no clue what they were talking about. Sorry, I didn't mean to go there, but it's true. So I would deduct that $10,000 from my earnings before taxes, actually before your interest, but it's okay. And the percentage of taxes that I pay at that level, 30-35%, somewhere around there, is what I don't have to pay for my write-off. So let's say it's 30% of 10 grand, $300. So I save $300 on my taxes, on my corporate payment taxes or my business taxes, depending on how your company's structured. So the structure matters, and that's because the tax code's so complicated. Which is why a lot of people like the idea of simplifying the tax code. So not only will businesses pay a certain amount straight easily, but so will people. And now, before you get to saying that's not fair, think about a company. If they've been measuring correctly, then they know how much their tax burden is going to be for the year because of budgeting, etc., etc. And they budget that 3 to 5 years out. If the tax burden is going to increase, guess what? They pass it along on price increases on their goods and services. Why? Because they're not going to lose money. And the government likes this because that actually increases the price of goods and services, which means that they get a higher percentage of that price, and the whole game starts over. Fun, huh? And if you're still with me, which probably nobody is, but that's okay. Statement of cash flow is one that's widely missed by pretty much every company I've ever worked at, and at least at the managerial level. Other than even, at some of the not-for-profit companies I worked with, just didn't even have an inkling that it existed. But your statement of cash flow is basically your cash on operating, cash on investing. There's one more, and I didn't look it up before I talked to you, and it's, as I said, it's widely missed, and I don't usually use it, but I kind of created my own form on this, because usually it's not asked for by the government or banks, where P&Ls and balance sheets are always used by banks and the government. Well, not the government, but it is, and you just don't know it. But those are the statements, and the cash flow basically tells you how it was explained to me by Dr. Raymond Schmickel, who was amazing. He actually came to my wedding. He was my informal mentor in college. He is an amazing man. Hilton lecture series, pretty much all the textbooks in the industry that are either on accounting or finance were authored by him. And I was lucky enough to learn all this when I was very young, and it was ingrained into my brain to a level where I don't really have to study it after that anymore, because it was just in my head. I don't get me wrong, I still learned moving forward, but the concepts were just, he made them so easy to understand. At least I thought so. I know a lot of people don't agree with me because a lot of people didn't like his class, but because it's accounting. Who likes accounting? Yeah, we're talking about it. So anyway, how he explained the statement of cash flow is that cash is your lifeblood of your company. If you aren't measuring your cash, you might have revenue coming in enough to cover all your expenses, but you run out of cash. And if you run out of cash, guess what? You're in trouble. That's where bankruptcies happen, where you have all these contracts outstanding, but you can't pay your creditors, and you run out of it. So the cash is a double-edged sword, though, because, well, cash is technically an asset on the balance sheet, is a liability because it's not working for you. Meaning your dollars that are just sitting in a bank account, while you need to know how much cash flow you need within a period of time, hence the statement of cash flow, if you're just sitting on cash, or it's in a CD or something low yielding, and you could utilize that in a better manner, then you actually have an opportunity cost that you're losing on that money, on that cash, I should say. So there's all sorts of things, velocity of cash flow, so many different ways of looking at how you utilize cash. But that whole adage of it takes money to make money, well, if you don't make money with your money, you are actually, we're back to that whole entropy, your atrophy through entropy. Sorry, I just got back at the narrow concrete here. Anyway, so I've talked a lot here. That's the three statements of accounting. And they do play together. Your net income moves into the balance sheet, and so do a few other things. Your liabilities go up and down based on what you've paid or what you've accrued. More debt or more liability. Those flow through to the balance sheet. But usually the big changes in the balance sheet are made during the end of the year or end of the tax year, in order to through the retained earnings calculations and all that fun stuff. And I'm not trying to get into any of that. I would have to be looking at the forms and really think through it to talk about it, but I'm walking. So, and the last thing that I wanted to talk about, and the reason why those three forms are so important, sorry, I jumped backwards just slightly, The reason why those forms are so important is because it tells you where you are. That's a balance sheet. It's a snapshot of time. I forgot to put that in there. Sorry, Dr. Schmigel. But it's a snapshot of time. It's where you are at that point. It's not a period of time. It's not over a month. It is exactly what liabilities you have, what assets you have, and your owner equity at a specific point. Whereas your income statement is a measurement of how you did over a period. Your income statement increases or decreases your assets and liabilities based off the whether it is a plus or a minus in either an asset or a liability, and then eventually equity gets changed. There's other things you can do. You can pull out draws, which changes equity, and you can, anyway, I want to move on. SWOT analysis. How this ties in is, if you don't know what you have at any point, how you did, if you haven't measured it, and if you're able to complete the process, that's that cash flow. If you're able to perform through the next period, it's that everything consumes something, and do you have enough of that thing to perform that task? So yesterday's talk about energy entropy through your attention. Do you have enough of your energy to pay attention to everything you need to do during that day? Do you know what you need to do? It fits. I hope you see that connection here. I'm sure you do. And the last thing is the SWOT analysis, which is your vision, your strategy. And it's an acronym, SWOT, SWOT, is strength, weaknesses, opportunities, threats. There's two different ways of looking at your business from the inside, how you're running things, and your business from the outside, which is how the competitive landscape is, the economy is, the outside influences on your business. So your strengths and weaknesses are your inside economy. So if you want to start with a strategy in your business, this is a good way to take a picture of where you're at. Get honest with yourself. Ask your employees, ask your customers how you're doing. What are your strengths? What do you think your customers would say about your strengths of your company? What do you think your employees would say about your strengths in your company? What would you say about your strengths in employment? What would your spouse say? Now, do it again with your weaknesses. And this is a hard thing to do because, I don't have any weaknesses. What are you talking about? And, if you lie about that, you lie about other things too. So, then you do that whole process again and you look on the outside. This is where you start looking at what factors affect your business. What are your opportunities? Is there a local company going out of business that is in your industry? What are your opportunities with that? Is there low interest rates right now? What are your opportunities with that? Can you purchase an asset for less interest expense, which means that your asset costs less over a long period of time, and you can get a greater margin? How did I not talk about margin? You can get a greater margin because that asset is producing revenue at a less expensive rate. So in other words, I kind of talk about margin without using the word. Your unit cost, your net operating income minus your expenses, your net operating income, which is your revenue minus what it costs to make it. That unitized piece is the margin. So on one widget, how much do you make on one widget? How much net operating income do you make on that one widget or that one unitized service? So if you have lower interest rates right now and you need an asset, a piece of machinery, a truck, equipment to produce more widgets or services, and you can get that for a lesser amount, that is an opportunity. Now, whether you can capitalize on that opportunity or not, there's that word capitalize, which goes back to your balance sheet, by the way. If you can capitalize on that opportunity, and then you start thinking about how does this fit within my strengths, weaknesses, opportunity, threats? So it's not just the fact that you can do it, it's should you do it. That is how you use the SWOT analysis. And then the other part of the outside forces is the weaknesses, opportunities, threats. So threats, what? Maybe it's high interest rates, or maybe there's a new, the government's coming down on whatever it is you guys are doing and adding regulations, because some lobbyist wanted to put up a competitive hurdle so it's harder for new businesses to operate, which is what regulations are now, because the important regulations have been in place for a long time. Although AI and other informational processes and ownership and all that good stuff is coming around the pike, and that all is going to hopefully have some regulation and laws around it. But so there you have it. And do you see how that kind of ties in the SWOT analysis? Whoops, I had to see where I was going. SWOT analysis is that strategy. It's that you have your goals, you have your vision. How do you get there? What's the strategy to connect the two? And then you come up with your tactics based off your strategy. You never start with tactics, because if you start with tactics, then you never know if those are actually effective towards what you want to move towards. So if you're building a strategy, then start with that SWOT analysis. Maybe I'll start with a couple other of these analyses and talk about those another time. Let me know if this was helpful. Sorry about the car. Let me know if you thought this was important. And I really look forward to talking to you next time. I'm about done with my walk. Thanks for listening.